Good afternoon, ladies and gentlemen. Welcome to the SUPERDRY H123 Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during today's meeting. However, the company can review all questions and we'll publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company would be most grateful for your participation. And with great pleasure, I'd like to hand over to CEO Julian Dunkerton. Good afternoon, sir.
Hi there, everybody, and thank you for joining us. So I'm just going to give you a sort of an overview of where we've been, what we're up to, Christmas trading, and so on. So it's a sort of tale of two stories here, really, and so much is really fantastic, and I think that might have been lost slightly today. So the biggest issue we've had from this business is where does the brand sit? Where are we being perceived by the consumer? And this Christmas, we've proved that we've turned this company around. So the brand has moved to positive territory on 2019 numbers, which is just fantastic. So sales are up all through December in both e-com and physical retail. We've delivered some of the biggest online weeks we've ever had through this period. And it really is testimony to the products that we've been putting forward and through our own channels. So we've had a real focus on women's wear. We've had a real focus on, obviously, our jackets, which have been incredibly strong for us. You've seen party dresses that we've never done before. We've got denim in positive territory. We've talked about denim for a long time, and finally we can say, look, we're on the right path. So actually, in terms of physical retail and e-com combined, we've actually delivered some really spectacular Christmas results. And you've seen the return of the high street driving revenue growth, so that's great. And that's in all our own territories. Now, the bit that's not so exciting, obviously, is the wholesale performance. Now, there is a natural lag between what we do in physical and e-com, which we're in control of, and what the wholesale customers are able to do when they've bought product a year in advance. So we expected more in-season sales than we achieved, but there is this natural lag, and there is a COVID hangover because people weren't able to come into showrooms so easily last year, and we do expect this to improve over time. We're also obviously helping ourselves to make that happen. We have a massive company focus now on the wholesale channel, so that we are fully engaged in trying to sort of bring that back up to speed. Obviously, there's an adjusted loss before tax of 13.6 million, and Sean will be talking to that later. We've got an upgraded CDP rating to an A. I'm incredibly proud of this journey that we're on in terms of our sustainability journey. We started life as a C when I came back into the business. It just is an expression of the journey that we're on, I suppose, to have an outside rating. And there's only two of us in Britain on this rating. I think it's us and Burberry. So very proud to be in that camp. And that is just an ongoing journey. We will continue to deliver on the sustainability process we're on. When we look at our social channels, where are we? How much progress have we made? You can see, well, you probably will be aware that we've had something like 60 million views on TikTok. We've got over 500,000 followers, multi-million likes. So we're making a lot of progress there, and it particularly resonates with the young consumer and the young products that we're adding that have resonated so well. There is also, with wholesale, a bit of a backward-looking view on products. They have not had access or haven't taken part in the new products that we are delivering to the consumer. So there is like I say, a product lag as well, in that they need to catch up. Refinancing is now complete with a larger facility, so obviously I'll be very pleased to have Sean back in the business, who's been distracted for so long. So that's going to be a real bonus to us to work together. And yeah, so current trading plus 25% in the 9 weeks to 31st of December. I'll just reiterate that over and over again because I think it's so important. And from a marketing point of view, a well-executed Black Friday, a well-planned. The marketing team is really coherent now, more coherent than it's ever been. We've bolstered that team. It feels very strong. We feel like we're working together now to really deliver the future. So let's go back and say, product improving, physical retail improving, e-com improving, social improving, sustainability improving, wholesale work to do. We're absolutely on it. And I'd like to pass over to Sean now.
Thank you. I'd just like to say before I go into this is a consolidated version of a much fuller presentation that's available or will be available shortly on our website. And in that, we talk in much more detail about the 6 sort of building blocks to recover wholesale. And I'm sure we'll cover it in some of the Q&As at the end of this as well. But I will just go through some of the headlines on the financials, some of which will overlap with what Julian's just said. And we'll start with the revenue, because there are some really important messages in there. And I'll reiterate what Julian said, which is the store performance in particular through the first half and then through the Christmas period, because we're covering 2 trading periods here in this announcement, I think is really impressive. So our store performance in the first half was up 14.3% on the year. That shows a return to stores, a mentality that's shifting. It's led by the UK, and I'll show you some numbers on that in a moment, but we are starting to see that happening across our European markets as well. So a pattern that you can see the UK pattern and the European markets follow it about 4 or 5 months behind. So that gives us some encouragement. And the flip side of that is that people have moved away a bit from e-commerce, and there's been many headlines from some of the pure play retailers who have struggled as people have gone back out to stores. And certainly the last 5 or 6 months have been a good time to be a multi-channel retailer where you can capture both markets. But even with that shift away, we've still delivered growth in e-commerce over that first half of 1.6%. But as you've heard, what's given us the headache is wholesale, and that is down 5.2% on the year. Now, in the first half, we knew about that. That's largely driven by the order books that we already had in place. The new news I'll come on to a bit later on. But again, some really encouraging stuff. We've done a good Black Friday. We've done a few promotions in our outlets. We've got a stock reduction program going on. And yet our full price mix has still increased through the first half, and it's increased by 4 percentage points. So we remain committed to Julian's strategy of turning this business back into a full price brand. And that shift from 74 to 78 is quite marked through that first half. This is what I'm talking about with the footfall. So the orange bars on here are this year against last year. On the left-hand side, you've got the UK. And I think what you can see is from spring, we've seen some pretty good recovery. As we came out of the Omicron panic, there was some really good recovery year on year. And that continued right the way through until October, when the temperatures hit about 22 degrees and nobody came out shopping for autumn winter product. And as we went into November and December, it went off the scale. And clearly some of the December numbers are a bit skewed by people's fears of e-commerce deliveries. That's particular to the UK, where there was obviously post office strikes and general concerns about couriers' abilities to deliver. But you can see it's been quite healthy most of the way through the year. And even on a 3-year basis, going back to pre-COVID, footfall has kind of settled at a rate now we can appreciate. When you look at the graph on the right, you can see the EU is lagging behind. So there is positivity year on year. But certainly the first half of our financial year, there was still a real hangover from Omicron. And in markets like Germany, footfall was still 30 and 40% down on the prior year. So that did give us a headache. And you can see from the black bars here, on a 3-year basis, there is still some recovery to come. as I said, we are seeing the same patterns there emerging, slightly different in different territories that we've seen in the UK. So we do have encouragement on that going into this year. Just looking at the headlines from our P&L, group revenue up 3.6% on the back of that. Our gross margin is down 3.2 percentage points, which on the face of it sounds concerning. There is nothing particularly concerning going on in our intake margins. This is driven by mix in our channels. So during the first half, in our retail channel, we saw a slight margin deterioration, or in our store channel, I should say, we saw a slight margin deterioration. And that was largely down to running some promotions in outlets to continue to wind down our sort of residual stock issue from a few years ago. In e-commerce, we also saw a margin decline, but that's actually good news because that is where we are building new customer bases with third-party e-commerce platforms, and they have shown fantastic growth through this year. Now, because the commission we pay to them gets charged into the margin, you see a natural dilution on the margin. And then in wholesale, we've also seen a step back on margin, but again, that's basically been driven by the deals we've done with TK Maxx to clear out some of that old stock as well. So there's nothing in here that gives us long-term concern. It is a mix issue and a consequence of actions we're taking that we've stated before as part of the strategy. That said, we're very mindful that the loss of 13.6 million in the first half is something we need to address. And obviously, we will see that significantly better in the second half as we come out of all the Omicron impacts. But you know, the business still needs to re-engineer itself to become more efficient and get our EBITDA margins back towards historic levels and in the double digits. Just looking at where the movements have been year on year, hopefully this explains a bit of the impact we've been seeing. So last year's loss was £2.8 million. Our sales added 5.5 million to that number at the bottom line, and you can see the breakdown between stores, e-commerce and wholesale there. But we saw some dilution from the margin rate of around 9 million too, so that's just pure variance analysis. Distribution saw some early hits from inflation. So within that £6 million increase, we're largely talking about fuel premiums, and we're talking about payroll inflation through the distribution networks, both in the UK and Europe. So that's what's driven that. And then the real issue is the 14 million reset in store costs. So as we've gone back to normality, the COVID rent waivers we were seeing have disappeared. That's worth 4.5 million. The rate waivers we benefited from last year give us another 4.5 million hit. And then, of course, we've got payroll inflation to the tune of 3 million. And the real issue is those costs returned at the beginning of the year, but the revenues, because of Omicron, didn't start to recover until much later on. So the first half is penalised quite badly by that. And the same is true of head office costs to some extent as well. So those are the reasons why we've seen a deterioration in that profitability. It is offset by some Forex gains of about 18.3 million year on year. Just over half of that is real, and that offsets the dollar rate hits we see in the margin, and the rest is balance sheet revaluation, which could unwind or reverse in the second half. The other thing we've made good progress on, and I mean, I'm particularly pleased with this, and I know Julian is, you know, these four lines show our stock through the year over the last 4 years. And it starts at a number of 17 million, but that was actually at 19 million when Julian first joined. And to bring that down as significantly as we have during a period of COVID, and then all the economic uncertainty that's sort of come off the back of that, and the amount of stock that people are trying to clear in the market, we're really pleased with how this exercise is going. And you can see that throughout this year, the black line at the bottom of this graph, we've been significantly lower than at any point over the last 3 years, and we are very much on track to get to our year-end number. If you look at the stock number in the balance sheet at the half year, it's actually up on the year, and what that shows is a improvement in our stock quality. So at the half year end, an increase in stock value, but 2 million fewer units held in the business. So what we've got is a lot more current season stock, high cost product, jackets, those sorts of things, that then unwinds as we go through the second half, and those things have sold very quickly. And really where a lot of focus was this morning was on our current trading and our outlook. So look, for the last 9 weeks, group revenue, 4.5%. The story behind that, though, is much more positive when you look at those things that Julian said in our control, and the place where we are seeing immediate reaction from the customers to our product. So stores accelerating from that first half number to plus 19% on the year for the nine weeks. And that is not just UK, that is across the whole of Europe and the USA as well. So really pleased with that number. And to do it at the same time as e-commerce really running away as well. 33% growth is fantastic. A lot of that growth coming from those third-party platforms, particularly in Europe, which we believe, in fact know in some cases, is attracting a new, younger, more female customer to our product. So it's really complementary sales and is quite exciting for us. So that leaves us with retail at 25%. And I think if you guys are based in the UK, you may see Retail Week publish every day a league table of performance, and it puts us firmly in the upper quartile of that. It's a pretty successful performance. The flip side is wholesale. On here it says minus 57%. It's a bit meaningless over a space of 9 weeks because it's based on dispatches, and actually the number is very small for that period of time. But the year-to-date number is more reflective of the issues Julian's talked about. So we are 18% down on the year, and that is likely to continue through the rest of this year. And it is that and some more conservatism of where spring, summer might go and the general mood music around the economy at the moment and the impact that might have on retail that has meant that we've deemed it prudent to reduce our profit outlook down from where we were at £10 million or just over down to broadly break even for this year. However, those issues in wholesale we believe are absolutely fixable, and that over the next 12 to 18 months we will be able to get that back on track while still building the stores and e-commerce on the success we've seen so far. And that, for this morning, is the end of our little talk. I'd like to hand back to our host, who could now open us up for questions and answers.
That's great, Sean and Julian. Thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review the questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the Q&A and the slide deck, will be available via your Investor Meet company dashboard. Julian, Sean, let's just jump straight into it. Obviously, we've had a number of questions. So firstly, thank you to everybody for your engagement this afternoon. And I'll try to not repeat the same kind of themes, but we had a number of questions around wholesale. And if we get that out of the way, first of all, we can move through some other topics that you might not have touched on so much. But if I may start off by, one of the questions is, can you explain in more details the problems around wholesale? And I know you've gone into that, but what are the main levers available to you to bring that to more profitable levels? And really, how optimistic are you that the problems are fixable? And if you could just give a bit of color around that, hopefully that will address Juan's question and Hans's question as well.
So, when I said it's got the full attention of the company, it's got the full attention of the company. So first of all, bring in Craig, who's head of director of retail, over to run both retail and wholesale, because so much of wholesale is actually a franchise business. So the sort of the coming together makes an awful lot of sense. Look, this is about really an imparting of information and a working closer with the top accounts in the world. So we have had a slightly hands-off wholesale team, you go out and sell the product kind of approach. And actually, this is now about an integrated approach between both the physical opportunity and the digital opportunity. So Justin and Craig meeting, and occasionally me, meeting the key customers in the world. How do we integrate our businesses to actually maximize the opportunity? And if I, say that we've done that, we've started that process obviously digitally with the partner program, but we haven't done it physically, and we haven't done it in combination together. And actually, that is really quite an unlocker of opportunity. If we take John Lewis, for instance, we've started the process with the partner program, and we're just about to start the process with a physical representation as well. We need to come together to make sure that we are offering the best in class for that partner in both channels. And that's really, really, really important. Now, if you take that, extrapolate that globally, the opportunity is vast. So moving away from a slightly hands-off approach to a much more let's have a symbiotic, collaborative partnership type approach and maximize that opportunity, because it is an enormous one. There has also been some move away from straight wholesale into the partner program. Now, while that has affected numbers thus far, it'll just be an add-on going forward because there's far less taking away from wholesale and adding into the partner program. The partner program will just keep adding now, and you'll see less sort of taking away from the old school sort of wholesale selling model. So really, segmentation, new team, new thought process, and a massive company focus, like we've been focusing everywhere else. I suppose this is a bit late in the day to be focusing on the wholesale, but we couldn't do everything. Product is moving in the right direction. Internet's moving in the right direction. Stores are moving in the right direction. Social's moving in the right direction. Sustainability's moving in the right direction. So now it's wholesale's turn to have that real company focus.
That's great. Thank you very much indeed, Julian. And Hans, I think the second part of your question follows on from the analyst presentation, so I'll present that to the company after today's call. Just a question here from Michael, who says, can you really talk us through maybe your plans to combat the reducing consumer spending? Anything there that you could add?
Well, the reality, I've been through a few recessions in my time. And actually, I found them great opportunities to expand. The reality is you've got to remember where we sit. We are the most affordable, well, in my opinion, the most affordable brand available. We really are. So you're proud to wear the product, but also, the cost to quality that we offer is really second to none. And I don't really feel any sort of breath of competition coming after us, particularly in the market we're in. And if you're adding a percentage to a more expensive product, the differential between us and the people that were more expensive to start with suddenly drifts even further in an absolute cost sense. So I'm feeling relatively comfortable that our position in the market is actually growing stronger from where we are. So I worry less. There is also a sense that the one thing that people will do is try and make themselves feel better when times are tough. And clothing actually is one of those areas that they turn to make themselves feel better.
And I guess on the other side of the coin, I'm more miserable. And so
the optimist, the pessimist.
What I'm doing is we're planning for that to affect us and believing, as Julian just said, that we are more resilient and have proven more resilient in the past than many think. That said, there is opportunity in this business to find efficiencies, and we are about to undertake quite a significant cost out program. I can't share too much of the details of that at the moment, for some of it's obviously quite sensitive, but also we're in the early throes of that. But the business has traditionally operated on quite high EBITDA margins, and we're not there right now. So there is work ongoing, and we hope to be able to share a lot more detail on this at our pre-close on how we get our business back to double-digit EBITDA margins.
Great, thank you. Well flagged, and I think everyone knows the cost of energy prices, but Anoop asks, are there any programs in place to cut energy use in stores currently, and how do you plan to mitigate any potential increases from here?
So we've been rather fortunate in that we hedged quite smartly. We didn't foresee this coming, but we just have some good hedges in place that have kept the most of the energy increases away from us so far, but that does put pressure on from next year onwards if the things don't reset. So again, that gets built into our cost saving initiatives. We have done an initiative to try and replace all of the bulbs in our stores with energy efficient ones, which actually has not only great for our sustainability message, but has quite a big financial impact on us as well. So there are sort of initiatives that below the surface going on to try and minimise that as much as possible. The head office here, we are sort of closing down certain buildings on various days of the week, just to save costs there too. So there are lots of little things going on to try and mitigate that.
That's great. Thank you very much indeed. Just expanding, I guess, maybe, Julian, you touched on the brand being, incredibly attractive versus maybe some of the peers. We have a question here really relating to the performance of the peers now, not going into detail, but how, generally, how do you see the peers performing?
how do I see
The peers performing
other
against
people
SuperDry.
performing?
Yeah, versus yourselves.
So the upper middle, I can see people could potentially move away from those sorts of brands. I think the certain people on the high street will be very resilient. The Zaras, the Urban Outfitters, areas will be resilient. But in terms of brands, I think the top end will always do well. It's where you've got the branding on the outside of the clothing is where people go when times are tough, because they want to show that they are feeling good about life. So, I don't think I can say more than that, really.
No, it's been quite interesting in the more recent short term to look at the Christmas trading statements that have come out, and everybody appears to have done slightly better than expected, or most people certainly have. But everybody's expressing the same caution we are today about where this is going. So I think autumn, winter, and Christmas was one thing, spring, summer is another. And there's just a degree of, and that's part of the reason we brought our profit forecast down, is just that growing sentiment that this could be a bit tougher through spring than everybody thinks. As I say, we're not seeing any early evidence of any problems on that front. I mean, it is very early days. We're still largely in sell and only small amounts of spring, summer coming through, but it seems to be holding up okay. But we've just got to be prudent in how we manage the business through this period.
That's great, thank you. I'm going to turn to a question from John, who submitted a number of questions today. John says if you could maybe talk about the store refurbishment program and its progress. Could you talk about any new concept stores that you may have discussed, and really just give an overview of maybe progress on that front?
Yeah, I mean, look, we're going to be realistic about our cash situation. CapEx is not something that we're rushing around spending at the moment. We've had great success with the stores we have refitted, and as and when we feel comfortable, we will continue that sort of development. But at the moment, we're being sensible with our cash while we just sort of go through this next 12-month period, I would say.
Exactly that. So the only commitments we're making at the moment are to the two ongoing projects, which is the replacement of our stock system, which is important to us, and the replatforming of e-commerce, which is coming to an end now, just having all the nice extra bits bolted on. The next two things in the queue are spending money on tech to interface with the partner program partners, because that's got huge value and return on it. And the next one is the store refurbishment program, but it is in a queue at the moment.
That's great, thank you. Sorry, I didn't know if there's anything else. Right, perfect. Okay, so the next one, if I may take from Steve K, around kind of what kind of KPI should one use to really kind of measure that brand recovery, and then follows on with, what are your thoughts in terms of increased marketing activities and how really you're looking to promote the brand? I know you touched on social and influencers and stuff, but any other colour there would be great.
Yeah. You can always look at sort of different brand heat sort of measurements, but really it's like sales that tell you the best measurement you can ever get. When your sales start going up, that means people are buying into the brand. I mean, my personal antennae is telling me I'm seeing more SUPERDRY product this autumn, this winter, than I've seen in years. But that's anecdotal. So like-for-like sales patently being the obvious measurement. And in terms of marketing, we have a much more sophisticated marketing team than we have had historically. So we've really bolstered it up. We brought in two new heads who have different, one sort of creative and one sort of performance skills. So we feel very confident in our marketing skills and strategy. So you will see an improvement in both visually and I think economically.
Yeah, we've introduced brand heat into our KPI reporting in our annual report, and over time I think we'll explore that a bit further and provide more detail around it. As Julian says, it's one measure. We've created it through all the different measures you can see. So Google searches, social media followers, all those sorts of things, to come up with this hybrid measure, and it looks quite encouraging as an early warning sign of where the brand is going. The other thing that's really helpful for us is having a very young workforce scattered across Europe who can feed back to us on what people are saying about it. And it's hard to share that as a KPI with any of you, but generally that's feeling quite a lot more positive than...
My real sense is that our focus on younger product is actually offering us up an audience that has never even considered SuperDry before. So while we have maintained our existing demographic, I think we've been quietly adding a new younger demographic, which I think is very exciting, because filling that pipeline is something you constantly have to do with any brand, and we seem to be doing that. And that's why we're having such success on TikTok.
That's it. That's interesting, because Aidan's submitted a question, Julian, that says, how does that customer demographic compare now to that of maybe 5-6 years ago?
Yeah. So when I left this company, what happened was the innovative product got taken out of the range, and which is why you saw the brand hurt in the last few years, or the last 5 years, 4 years. What I've done is reintroduce a sort of innovation pipeline of younger, well, not just younger product, but I mean just new products that are moving the brand forward and testing new areas for us to move into, rather than being reliant on exploiting the existing products and shapes. What that does is obviously bring in a new demographic, which is key. So the product innovation part of this business and reintroducing that 12-month-a-year design cycle has revolutionized our sales for this December, and also will revolutionize the future of this business.
That's great. We've got a number of questions from Sander, so I'm going to try and take one just to make sure I'm covering everybody that's got a question, and anything we don't answer, we'll try and get response back post this. But he talks about rent, and what is your share of your rent is turnover rent versus fixed price rent? And is the H1 rent level to be annualized for the full year, or are there more discounts that potentially might unwind?
Good question. I think from memory, turnover rents as a proportion of the total is running around 20%. I have to confirm that. I think that's roughly what it is. And is there discount? There is a little bit of discount in the second half, but it comes a bit immaterial. The whole sort of COVID issue is now unwinding, and the only thing that's left is those leases that are expiring are still having conversations with landlords about how to bring the rents down at lease renewal. And thus far, we're still seeing results of between 38 and about 45% rent reduction on each lease we're renewing. So there is still some momentum in that, which should see improvements for us over the coming year.
That's great. Sean, I might stay with you if I may. Question from Aidan that reads as follows: there appears to be significant FX exposure. To what extent is FX risk hedged?
We have a policy which says that I'm sort of, I think, 90% hedged for the next 3 months, and then that drops down to 80%, 50%, 60%, and that stretches out over 18 months. There is exposure on our balance sheet from overseas assets and liabilities and some of the intercompany balances. And of that 17 million of Forex gain, that's about 6.5 of that. We've chosen to leave that a little more exposed in the short term because it was being hedged by overdrafts that we were holding with our banks, but that left us open to foreign currency fluctuations on our liquidity, which was more important to protect. So that 6 million is variable and fluctuating. The other number you see in the P&L is all about timing. So there is a 10 million gain through the FX line offsetting about 3 million of hit in the margin, and the rest of that hit will come through the second half. So over the full year, the whole thing wipes out. But half on half, it does look a bit odd, I agree. So that's how our hedging policy works.
That's great. Comment from John, I'll read it out just because I think it touches. Congratulations on the results. Anyone who's taken the time to read the results can see the positives and the continued turnaround. John then goes on to talk about refinancing and appreciate that it's been challenging. But are you able to confirm around the interest rates that you're paying on any new debt facilities?
Yeah, so in our announcement on the 23rd of December, we outlined as many of the parameters as we could on the new facility. But essentially, we're paying up to double-digit interest on it. The reason we chose to go with Bantry Bay is because they offered the most flexibility of all the lenders that are working with retail at the moment. Most people were offering us a term loan across the whole duration, which meant we'd pay interest on the full amount. And with Bantry, they've done it in two amounts that we can draw down in 10 million tranches, which, whilst it makes the interest rate more expensive, it makes the absolute interest charge across the year much lower than some of the other guys we were looking at. But I refer you back to our announcement on the 23rd.
That's great. I'm trying just to make sure that I use your time as best as I can. I know this is the day of your results and you've got back-to-back meetings. Hans W asks an interesting question. Superdry makes most of its sales in the winter. Are there any products for the coming summer season that will boost sales figures over this period, especially for Generation Z, as you're currently trying to reach via TikTok? I guess that younger demographic that you talk to. Anything on that you could open?
Yeah, so particularly with women's wear, I mean, we're making progress everywhere, and I would say, you know, you're really feeling that progress in the stores now and online. But if we look at women's products, I'm particularly excited about a key trend with the sort of 90s block tees, which may not mean a lot, but actually is quite significant, because what it means is you are selling a fashion block with a brand statement at the same time, and that's quite key actually. So I'm particularly excited by that. I'm excited by parapants. I'm excited by wide leg jeans, skater jeans. We've got a men's collection called Merchant Store, which is really exciting. We've got a female collection called sort of Ibiza, which is all about like white muslins and cheesecloths and so on. So giving a real kind of holiday selection. So we've done a lot of things actually that we didn't have a year ago. So yeah, I'm quite excited by what could happen.
That's great. There's also a number of finance questions here, which I'll probably just leave for you guys to review post today's meeting. But given time, and I do know you have back-to-back meetings, we have one question. You did mention a new team earlier, pointing maybe to a redirection. Just wondered if you could give any colour or some light on that new team.
So there was team marketing or team wholesale?
Craig taking on wholesale.
So Tom Hutt and Denise Posner coming in for marketing. Tom on the creative, marketing creative, and Denise on the sort of performance marketing side. Brilliant to surround Justin and give him an absolutely formidable force behind him. Craig has moved across or broadened his remit from pure retail. He will be bolstering his team within wholesale to really deliver a more sophisticated sales presence, if you like, and that process has begun.
Great.
So that is slightly incomplete, but started.
Perfect. Well, Julie and Sean, look, I think I can keep you and make you miss your next meeting, but I will thank you for your time, and I'll thank everybody for their questions. And sorry if we haven't got through all of them, but as I say, we'll make these available, and any additional comments we will add and notify you through the normal channels. Julie and Sean, I know investor feedback is important to you, and I'll shortly redirect those on the call to give you their feedback. But before doing so, I wondered if I may just ask you for a few closing comments just to wrap up with, and as I say, I'll then redirect investors to give you their feedback.
No, I mean, I will just reiterate, you know, of all the things that we do, physical retail is getting to a much better place, pointed in the right direction. E-com is pointed in the right direction. The product is absolutely pointing in the right direction. Marketing is pointing in the right direction. Sustainability is pointing in the right direction. And wholesale is now our key attention to drag that back into positive territory. So, you know, while I'm sort of apologetic that we're behind on wholesale, we will get there.
Right.
Thank you, everybody.
Thank you all for your time.